So far, we have a great track record. It's a wonderful event. Thank you to all the sponsors who have helped us, and all the speakers, the analysts, and of course, above all, thank you to you for being with us and making the event, I think, a very good success. We are delighted and honored to have with us John Stoltzfus. He's the Chief Investment Strategist from Oppenheimer Asset Management. I have to confess, we were hoping to get him as a keynote speaker. So when he said yes, we were very happy to have him. You know him. He's very well known around Wall Street. He is very well read, very well spoken. He has particularly insightful and strong views. If I may say, during lunch, he told me, Nicholas, I have been one of the early bulls, and I still remain so. So thank you. With that, I will invite him to the podium, and please take over and guide us through. And thank you very much for being with us. And he's going to take a few questions afterwards. Thank you.
Thank you very much, Nicholas. Thank you. Appreciate it. And thank you all. I hope I can keep your interest now that you've had such a good dinner or good lunch. The food was extraordinarily good. I feel like a character out of Wodehouse, P.G. Wodehouse, for those of you who are familiar with British literature, in that they were always talking about the chefs earlier in the last century. And the chef had an excellent piece of fish on my plate that was just fabulous. I hope you enjoyed your meal as much as I did. As Nicholas mentioned, I am one of the early bulls in this bull market. I turned positive had a positive outlook on the recovery of the U.S. economy and the U.S. markets as early as January 20th of 2009. And I couldn't say that if the press hadn't been there the day that I said that. And very fortunately, there was a reporter at an event at the time. I've worked on Wall Street since 1983, so I've been through every boom, bust, and recovery cycle since that period. And I've worked at many firms. Some of you may have worked at those or may work at those today. I worked at Dean Witter 30-some years ago. I worked with Chase before it bought J.P. Morgan. I worked for Morgan Stanley for a number of years, Midtown here on the Broadway home office. And I worked also for a small bank by the name of Bank of America. You may have heard of it. And as well as a small firm called Ticonderoga, an institutional firm, between in 2009 into 2010. I also teach at New York University a class called Intermarket Analysis and Market Strategy for the last 10 years. And currently, and I hope for the beyond the foreseeable future, I work with Oppenheimer Asset Management, located at 85 Broad Street. But anyway, let's get back to 2009. It was January 20th of 2009. I was driving up, I was in Des Moines, Iowa, on the same day that Barack Obama was being inaugurated president in Washington, D.C. It was a gray day in Des Moines, Iowa. That morning, I was meeting at a breakfast with some clients, high net worth clients and their advisors. And in the afternoon, I was at an event that was sponsored by a local business publisher that was where they invited people from the community as well as clients, again, of financial advisors and their advisors. There was also a panel. I was the keynote speaker at that event as well, and there was a panel with local economists from local universities, as well as local economists representing government agencies in the area. Everybody had a long face. Everybody was very concerned. The markets were still coming down from after 2008 into the first quarter of 2009. And I had a positive message. My positive message essentially was, as a longtime equities guy, I'm also a big bond market watcher, and I very like to feel closely attuned to whatever the Fed is doing. And I thought what Ben Bernanke had done up to that point was just terrific. And I thought Hank Paulson had done a great job finishing up his tenure as Secretary of the Treasury. and I thought we were well positioned. We were expecting at that point the economy to rally in the second half of the year, and I had confidence that after what the government had done from the level of the Fed and the Treasury, that we would get some kind of a bounce that would be likely something we could build a platform for a recovery. So with this positive message, luckily that guy with the press was there, because I'd never remember it. I fortunate to speak at so many events that I probably would not have recalled saying this. But the guy, and as a New Yorker, the way I heard it, it sounded like this to me. Okay, pal, if you're so positive about the markets and the economy, when do you think the stock market is going to come back? The first thing I thought was, my gosh, the audacity of the press to ask this kind of a question. I said, here today, as the markets come down, we've got change of leadership in Washington. And then I just picked it up from there. And I said, well, we're expecting the economy to bounce back in the second half of the year with all this liquidity that's going to be applied. So I said, I'd expect the market as a discount mechanism would likely rally as early as the end of the first quarter of this year, which would have been March 31st. Well, as you know today, and I know today, the markets were kind to me. They didn't wait until March 31st, but we got that bounce on March 10th after a disaster on March 9th when we hit a low of 676, as I recall, and midday we hit 666, which of course everybody was very excited about. Oh my. But we have stuck to bullish calls since that time. In fact, in the remainder of that year, 2009, I'd left B of A and was working with that other firm, Ticonderoga, before I got to Oppenheimer. And I was quoted something like 400 times in the press, not necessarily, I think, because I was such a great writer, but I was one of the few people who was bullish. and so I even landed on the front page of the Financial Times of London, which I thought was extraordinarily global of me, and I was very happy with that. My colleagues at the firm that I was working for at that time pointed out that my name was on the first half of the fold, and the firm's name came on the second half of the fold. But I was happy about it. But we've remained positive through the Greek crisis in 2010, when there were more specialists on Greece on CNBC and Bloomberg Television than you can find at the Metropolitan Museum of Art up the block. And we didn't think the Greeks would leave because, very simply, we thought they couldn't afford to. We thought that, and from a perspective of the European Monetary Union, while many were calling for the end of the euro, we thought the euro, it was a good reserve currency. It had a lot of interest and strength. We didn't think there was a problem. We held this point through. You remember was it 2012 when the big story was we were going to go over the fiscal cliff? Was that it? And indeed, the politicians did hang us over the fiscal cliff, but they didn't let us go down the other side. And was it 2011 when we had that's when the U.S. lost its AAA rating. No foreign government would ever buy a U.S. Treasury again. Remember that? So we've held positive through a lot of these things. A lot of our work relies on very deep dives into economic data on a global basis, political analysis, demographic strengths and weaknesses that we see, current business trends as well as secular trends. And of course, we're always looking at top-down and bottoms-up analysis related to earnings and revenue trends, not only stateside but on a global basis. And we are still positive today. Every day when I wake up, and I keep a Bloomberg in my bedroom, all right? It's not the old terminal that we remember, but it's, off of the clouds on a laptop. I always check it, looking to see where Asia closed and where Europe is doing. Always seeing if there's been some kind of a change. But I think we've been extraordinarily lucky this cycle that the role of the central banks around the world has not only remained important, but that it has had leadership that has been remarkably good about judging what was broken in the global economy, what was broken in the banking system, what was in terms of where leverage was, all the difficulties that had occurred from too little regulation, self-regulation, which is essentially no regulation, then too much regulation, and then changes in terms of the technology and globalization that had brought. I can remember many years ago in 97, during the tech bubble, 97 through 03, a period where technology was relatively new. At the time, I was with Morgan Stanley at that time at Midtown, and gosh, you'd get freezes on the screen very, very easily. There would go your internet coverage. You know, today in the middle of the night, unless you have trouble with your cable provider or you got direct satellite TV, usually your internet coverage is pretty good around the clock. But things have really changed over the last few years, and I know strategists have to be very careful about saying this time it's different, but certain things have definitely morphed or evolved since that period. And that is that globalization has come of age. Repeatedly since the crisis, we have seen the concept of decoupling of economies or regions of the world, emerging markets from developed and developed from emerging. It has been debunked repeatedly for the simple reason that the global economy, both in terms of production, delivery of services, is so intricately entwined that we can't afford to live without each other. We will often find that our politicians will create all types of global risk. And by the way, when I speak as strategist for Oppenheimer, I am always politically agnostic, so I offend all sides, okay? I offend conservatives, liberals, centrists, populists, and anything on all sides, because I just call it the way I see it for the markets. You know, I'm always looking, what's the best benefit to our clients, our advisors, and the firm, and what type of market are we facing? And but when we look at it today, from a point of view of the global economy, we have technology has lowered the barriers of entry to competitors on a global basis, like no other time that I can ever recall in the last 35 years in this business, in that companies that are new formed corporations can very quickly, aided by technology, whether it's advanced logistics, whether it's CRM, customer relationship management, whether it's the ability to digitalize advertising, one's message, social media, what have you. But in a very short time, relatively new companies can become the global competitive peer of long-established developed market companies. And what that tends to do is it puts a cap on pricing, because as we all know, unless you have an extraordinary innovative stance, you have to watch what you charge for your services or your products. And we think that's disinflationary. Then, of course, there's algorithms in the offices and robotics on the factory floor that have reduced the need for as many people as would have been needed to deliver X number of services or X number of products than in other eras. So we look at the current environment, we see a global economy that is growing at a decent but not at a terribly robust pace. We also see that there is a reflation occurring, but that's what the Federal Reserve and other central banks have been looking for a long time. And we say, why complain about it? We think a 3-point, what was it earlier today? Was it 3.1% or 3.19? So just about 3.2 on the 10-year, was it earlier today? Would somebody correct me if I'm wrong? Don't be afraid to shout out, but I don't want to have to look at my Bloomberg. But my point on this is that with the inflation that we have today may be the welcome reflation we need. We don't think that with wages kept in check as a result of robotics on the factory floor, algorithms in the offices, and global competitiveness that is outstanding today, we don't think we're going to get the type of worrisome inflation that once caused the stock market a lot of trouble. So we remain positive on equities. At this point, we are allocated in our allocation model around 68% equities, global equities. In the U.S., we are market cap agnostic, essentially exposed fairly evenly to large caps, mid caps, and small caps, and glad At the beginning of the year, when many were talking about you just had to be in large caps, we held to the market cap agnostic. Worked out pretty nice. Right now, mids and smalls are outperforming the large caps for the year thus far. And we think in this environment, it's important to be, or to consider market cap agnosticism, because these markets, because of the digital delivery of information and the response to different changes within the economic landscape, can cause a significant rotation and rebalancing intermittently that rewards one market capitalization over another, but for a relatively short period of time. On a global basis, we are heavily exposed internationally, but underweight compared to the U.S., but we have a decent exposure in Europe, in Japan. We have exposure as well in the emerging markets as well as in the frontier. And of course, I have to add to this, we do it all with ETFs. We also have portfolios that we call hedge your alpha with beta, where we mix individual equities and ETFs. But we also think in the environment that we're in, highly prone to rotation and rebalancing, where terrific stocks can just get battered overnight on short-term trading, that can be much more valuable to be held intermediate to long-term. We think it's a good idea to use ETFs to hedge your alpha positions. It gives you the ability, oftentimes, if the alpha is failing or is weakening, you'll find that your beta is strengthening, so long as it remains a good opportunity for equities. Related to the U.S. dollar, we had expected in 2017 that the dollar was going to weaken. We had published in 2016 when many were expecting the dollar to strengthen significantly. We thought the dollar was overpriced. It came down last year. Tell you the truth, this year we were looking for the dollar to continue weakening, as it did indeed up until, about a month and a half ago. We think the current strength in the dollar has a lot to do with the uncertainty related to the potential for trade disruption via tariffs that could be imposed between China and the United States. We think the market's concerned about that. We also think that the dollar, of course, is getting a bid because the U.S. economy is doing substantially better than most other economies around the world, even as we have a global economic recovery in place, and in the U.S., an economic expansion. When it comes to energy and commodities, we'd have to say we were wrong on that. I got to tell you, we were right last year. We were underweight energy. We were underweight energy coming into this year. We carry, versus the S&P 500 that weighs the energy sector at around a little bit over 6% now. We're at around 4.4%. So we're still participating. But we think the strength in the price of oil is related to three things in particular. The first would be, of course, we've got globally, there's increased demand as the economy of the world improves. Secondly, the weakness of the dollar from last year into the start of this year through most of the first quarter also makes oil cheap for foreign buyers of oil, which is primarily a dollar-based commodity. And I've found, I don't know if you have, but in my experience, I've found that when the dollar is cheap, foreign users of imported oil will most likely buy not only what they need, but then they will stockpile it, then they will hoard it, then they will speculate in it, and then they would drink it if they could. And we haven't gotten to that state yet, but oil still has plenty of support. I also think that the alternative energies are just still not strong enough in terms of infrastructure delivery to really put much of a dent into the price of the oil up to about 80, 90 bucks a barrel, at which time I would expect so. Of course, the third thing is, as you all know, you have OPEC. Amazingly so at this time, OPEC has been members of OPEC have restricted their production and not cheated for the most part. I don't know about you, but I can never remember that happening before. And this time, they've really stuck to it. And as a result of that, another supporter. But we can't help but think, as the price of oil moves higher, and earlier today, I think the press was reporting, as I awoke, they were saying $80 on the barrel of oil. I said, that's got to be Brent. I looked at the Bloomberg. It was indeed. That was the Brent price. But stateside, it was about $6 under that, as I recall, around 74, but creeping higher. We just think that there's just a matter of time before producers, whether it is Iran or whether it is producers in the Permian Basin, just finally saying, we're going to pump more, and we think that'll bring the price of oil down. I'd like to show you a couple of charts just real quick, and then, if I may, let's see, this clicker, it looks like it. Okay, I got a chart book. We publish a chart book on a monthly basis, and if you can see this, one of the things that has carried considerable weight on a day-to-day basis in terms of short-term trading has been the fact that we have not had a lot of pullbacks in the last year. Bear with me a moment. I think this is somebody trying to scam me. It just happens, There we go. It's just really something else. Anyway, I distracted myself. Let me get back to this. When we look at this, we went back all the way for the last, we went back 20 years, all the way back to 1998. Hard to believe 1998 is 20 years ago, but it is. And what you notice, if you look at the extreme right hand, is you look at the extreme right column is the annual price return of the S&P 500 in all the years since that time. And you'll notice after the tech bubble burst in 2000, there were 3 successive years of losses for the S&P 500. But then after that, when the market recovered nicely, there wasn't a significant decline in the market until 2008 on an annual basis. The market was off 38%. It had another 20% to fall in the first quarter of 2009 before March 10th. But overall, the next year, the market in 2009, the market was up 23.5%. 2010 was the Greek crisis. On the left, the first column is the maximum drawdown, which was about 15% that year in 2010. And yet for the year, we were up 12.78%. 2011 was a flat year for the market. I think if you reinvested your dividend, you might have been positive, but it was a flat year. But then 2012, 2013, 2014, 2015 again. Remember when the Chinese devalued their currency in August? There was uncertainty about growth. Oh my, if the Chinese devalued their currency, the thought was that would be the end of the world of trade as we knew it. And yet, we're fortunate. We looked at it. We couldn't help but think. Our first trip to China had been in 2004. At that time, the yuan was around 8.3, 8.6 or so. So in 2015, when the yuan was at 6 and change and they wanted to devaluate it, we thought, this is really, they've just withheld their currency so high for many years, we weren't surprised. But you'll look there, the market discounted that pretty quickly. And in the last few years, of course, we had 2016 was 9 and 2017 was 19%. Now, why have I labored through all these points in the market? The reason why I like to say is every one of those years, for those of you who deal with clients on a one-to-one basis, whether they are institutions or whether they're individuals, because I've seen incredible bearishness from institutions from beyond the crisis date up until just about last year. When you look at this, is every one of those years there was something that happened in the markets that said to you, this is a good reason not to invest. And yet, that thought is proven wrong repeatedly since 1998, notwithstanding the 2008 debacle. Now, what I'd like to say is, in our opinion, we believe that part of this has to do that markets today discount both good news and bad news quicker than ever before. I can remember when I started on Wall Street in 1983, I was like Bud Fox. I'd take the train down to Wall Street. I was reading the Wall Street Journal. I'd read the Wall Street Journal on the train. I'd read the Wall Street Journal walking up the steps. I'd cross Broadway, headed to the Trade Center at the time where I was working. I'd still be reading the Wall Street Journal. Get to my desk. There was a Quotron machine or a Bunker Ramo. For those of you who remember that, it was a primitive vehicle. Essentially, you would type in, the bellwether of the day was IBM. Enter. All of a sudden, a price and a volume figure would show up, a bid and an ask. You also had news from the Dow Jones News Retrieval Service, but it was all about 20 hours old by the time it got on that screen. Today, a 12-year-old in the middle of the night with a decent laptop connection can tell you where Singapore is trading and how it looks that Europe is going to open that day. Its information is so quickly disseminated. People still need experts, people who are understanding of the markets and the relationships between all the asset classes, the currencies, the stocks, bonds, cash positions, commodities, what have you. But the information is out there. The question is what to do with it. But the market discounts very quickly. I don't know about you, but in 2008, I can recall very highly trained professionals saying that basically where we were headed was to very low returns for the stock market over the next few years. And in 2009, during that first quarter, I can remember one guy who wrote, the best the stock market can expect to gain is 3 to 5% in the next decade per year. And you know, the average annual return since the bottom on March 9th of 2009 is around 16% per annum for the S&P 500. However, I like to go back to the last cyclical peak when we were at 1565, and that was on October 9th, 2007. And since that time, the stock market is only up about 5% per year annualized. So what I propose to you this day of our luncheon here, and I hope I'm right about this, is what it may indicate is this phenomenal rally that we have seen of a bull market that has been able to climb against significant walls of worry just about every year has really been tied to the fact that the market was recovering from a horribly oversold condition. And that in reality, we probably have further upside from this point, perhaps for the next few years, so long that the Fed doesn't get too excessive increasing rates or doesn't miss the buildup of inflation that it might need to address near term. So long as we don't get a protectionist trade war brewing, if we get through these things, and I would think that if we get some kind of an agreement, even if it's just an extension to negotiate NAFTA, I think we could get a fairly decent rally attributed to that. And if we get a deal with the Chinese, I think it'll be extraordinary. I think we'll get a real jump in the market. I think our biggest worry then will be another melt-up. And I'm not a big fan of melt-ups. I like to say no boom, no bust, no boom, no bubble, no bust, I'll take it. Give me a market that climbs a wall of worry as this one has, and I'm very, very happy with it. I'd like to ask, are there any questions here before we adjourn? Yes, sir. You know, that's a good question. I'll have to say I would have to refer that to our area that deals with advising pension plan sponsors. But I would have to say this, is that pension plans in the last few years, over the last 10, 15 years, if anything, moved away from both the bond market and stock market and moved to alternatives and are now just beginning to go back to the traditional markets. I would expect that we have an opportunity to see pension plans participate much more in the equity and bond markets in the next 5 years than they have in many years before. I think one of the things that might do it is the transparency, of course, is very important, I think, especially as the population begins to become more attuned to the fact that planning for retirement is essential. As positive as I am on the outcomes for the market, I am concerned about the baby boomer generation, which I believe predominantly has underfunded their pension planning through their own savings. So I think there's a good opportunity to see a change there, but I think the change wasn't so much that they went to equities and left, but they went to alternatives. Yes, sir.
How much of that 16% annual pension might be due to company buybacks and merger and acquisitions?
I think, I can't give you a percentage on that, but standing up here at the podium today, I'd have to say I would imagine at least 15 to 25% or more. However, the buybacks, I think, were essential in that most companies in most industries today have a very high level of building too much capacity because of that technology and globalization factor, which creates lower barriers of entry to competitors and a myriad of businesses. So I can't help but think by removing shares from the marketplace, in effect, they have been able to reward their investors for their support, their shareholders, but at the same time avoided the risk of developing overcapacity. And the percentage could be larger. I just really, it has not been. I was never a fan of buybacks until the current cycle because of this overcapacity issue. And we began looking at the overcapacity as it started in China, when China got into the aluminum smelters way back in the late 90s. And the big difficulty was China was very capable of creating overcapacity in just about every rust bucket type industry. And then as it goes forward, it's in technology. I mean, look at the situations we have today. Yeah, let's say, and if you take that out, what are you writing, 12% per year? That's still pretty good. I'll take it. And the fact that they didn't build overcapacity, or that they at least reduced the exposure to developing overcapacity, I think is a real positive thing for the markets. Yes, sir.
At what point does longer duration not your end?
I got to tell you, I would have to say our exposure, and it's a small percentage of exposure, about 9% in our allocation is to midterm note duration. And we've probably been wrong on that. This is the biggest, the only thing I can say on a parallel basis is I can remember speaking with fiduciaries of pension plans, small companies here in New York City, and in 19, like it sounds like father time here, but in 1984, 85, saying to them, I think you should buy these U.S. Treasury 10-year zero coupons at 14%. They compound, they're not callable, and inflation has begun to show signs of declining. And invariably 80 to 90% of them said, no thanks, Johnny. We want to be sure we stay short-term because we know inflation is coming back. And of course, it didn't happen for the next. It's not that it didn't attempt to come back. If we, I think I have I know I have it in here. If I go, okay, let me see if I can just, I like the way this sort of, here it is, that was it, that's what I was looking for. Here's the 10-year Treasury yield. I think that's a 40-some year stretch, so it peaks around the time I got into the business. I got there for the second peak. But you'll see it wasn't a straight line down. It ratchets its way down. I expect it will ratchet its way up again, but at a relatively quicker pace, because it's always pain is inflicted faster than pleasure. Anyway, and so when you when you look at this, the way this is, I'd have to say, I get very distressed when I look at a 30-year and see how little it pays. But I think what's supporting the 30-year right now is institutional users who have end periods that they need to meet with certain amounts of capital and a guaranteed return. I think what we're going to, the real deal right now in terms of cash are treasuries that are just around 2%, T-bills, and of course you've got the 2-year and the 5-year that are very attractive, but they're not good for goal-oriented investments. We all know the rule of 72. The good news is if you get 1% on your money guaranteed, you'll double your money in 72 years. I don't even know if the youngest person in this room will be alive in 72 years, but perhaps with greater longevity. And if you double that to 2%, what the heck, it's only 36 years. But you take that up to 6%, suddenly in 12 years, you've got a good opportunity. So I always like to say when it comes to a mix of diversified securities, it's important to right-size your expectations, and you just might be pleasantly surprised as we have been. Any other questions? Yes, sir. Yeah, I think the tax reform near term is certainly has been so far very helpful, but in terms of its contribution to deficits is quite worrisome. My attitude towards the building of deficits at this time via tax reform is if we had built the deficit looking forward the way we are doing with lower taxes for corporations, and at least to some individuals, though if you live in New York, you're going to get killed right this year. But my thought is that you have to look at it, what alternative did we have? If we were increasing the deficits for some type of a social program, whether it was free health care for everyone, a guaranteed wage for everybody, that would be a bad thing. But if this gets companies to invest more in their businesses, if it raises CapEx, if it helps corporations get through this period of interest rate normalization, creating greater liquidity for corporations via lower tax rates, just as the Fed is removing liquidity from its very important commitment to normalization, we can't help but think it's a worthwhile risk to take. Longer term, we have to deal with fiscal reform at the government level that is as hard as herding cats. I don't know how we do it. It's the gang with the $800 haircuts, you know, that has the benefits that are. Are you amazed by the benefits that the House and the Senate have in terms of their health care and retirement? Everything's built in for them. They should have to experience it the way we do. The do-it-yourself be a very practical point. Not a political statement, mind you, but just something that could help reduce the deficit, because the more people feel the heat, the more they're likely to move. Any more questions? I want to thank you all for your time. Thanks so much. Appreciate it.